Hey everybody, welcome to class 18.1. We're continuing where we left off last year, where we looked at the economic calendar in class 18. Within that class, I taught you how to utilize the economic calendar as a way to anticipate future price moves. So today in class 18.1, I'm going to be introducing to you seasonal tendencies. By the end of this class, you're going to be learning four key takeaways. The first is that you should be able to define seasonality as a source of high time frame directional bias. It's not a signal, it's not a trigger, it's a bias. The second thing is that you should be able to look at a seasonal chart and identify historically whether there is bullish or bearish price delivery for a major asset of your choice. The third thing is that you should be able to synthesize seasonality with the economic calendar, the market profiles, as well as advanced price stages in order for you to establish, again, a bias in order for you to anticipate future price moves. And finally, you should be able to apply a 5-step workflow that integrates seasonality into your trading without it becoming the reason for you to start trading. What do I mean by that? I mean that because you'll be able to use seasonality to establish your high time frame directional bias, coupled with the economic calendar, market profiles, advanced price stages, in order for you to determine or confirm, or rather validate your anticipation of the future price moves. That means that you should only cherry pick the best quality trades. On the flip side, what this also means is that because you're able to choose only or cherry pick the best setups, the outcome of that is that you should be trading less. You should only be choosing the best setups. Okay, let's just very quickly establish what is seasonal tendencies or seasonality. And seasonality, as a metaphor, it's what we call the market's historical compass. And this is where it slightly deviates from that concept of a market wizard's map. Okay, this is a compass. It's an almanac. And the thing about compasses is that it doesn't tell you where to go. It doesn't give you directions as to from where you are, from point A and how to get to point B. What a compass does is that it points you in the right direction. Okay, and in this case, it points to you whether it's bullish or bearish, simply put. So what, now the second thing is that where does this word tendency come from? Okay, well, let me be clear. Seasonal tendencies and seasonality, they mean the same thing. Okay, the tendency aspect comes from the fact that seasonality, it's a recurring historical tendency for price to be bullish or bearish during a certain period. And how do researchers and analysts who specialize in this field of study. How they get to this is that they collate and collect and observe markets, particular markets, over many, many years. So it's actually a couple of decades worth of work. So, what seasonality isn't is that it's it's not a predictive signal for entries. It's not a guarantee of future performance. Meaning to say that just because you be able to view, um, say between May to July, bearish price delivery that was historically observed over many years, um, it doesn't mean within that particular year, uh, last year, for example, that that's a guaranteed that's a guarantee where price would deliver bearish from May to July. Um, it doesn't guarantee that at all. It's just a compass. It just points you in the right direction. Um, so it's a way to confirm not only bias in that sense, but it's also a way to confirm whether it's a good time to be going into the markets or not. Okay. If you observe price not behaving the way it's supposed to behave during a certain period of the year, for example, if you're expecting ES to be bearish from May to July, which it usually does, that means in the context of whether you should be going into the markets or not, it should tell you that something is up and that price where its behavior was consistently observed to be repeating, once it stops doing so, it should ring alarm bells and tell you as a trader that you shouldn't be touching or participating within that market. Okay, so there's many ways to utilize seasonality. It's a way to establish bias, um, but it's not a guarantee. It's just an added validation to, or a confirmation that supports your thesis or your trade idea, and in order to inform you to make better decisions. Therefore, it goes back to what I just established earlier, that not only should you be trading less, it should also enable you automatically um, to select and cherry pick much better setups. And part and parcel of that also is to not do anything. If you don't see any of these confluences of that supports your thesis or your bias, then don't do anything. And so, and wait until this situation clears. So, seasonality, very straightforward. It's observable, repeatable price action that has historically been observed over many, many years. It's a data that's collated, and we should treat it with respect and utilize it much like everything else that we utilize within our trade craft, to give us, to make us more informed as traders. Now, how do we read these seasonal tendencies? So, although these charts, they don't show price over a single time period, they show a high time frame progression of price that's average over many years. Okay. So over here, we're looking at the seasonal tendency of heating oil. And in this example, we can see that between January to July, what do we see? We see bearish price delivery, right? And so the extreme discount for this particular asset, we can observe making lows or lower lows between June and July before there's a rally. Okay. And this is, in a nutshell, visually speaking, this is how you read a seasonal tendency. Now, the seasonal charts that I've already handed to you in an email earlier today, those are the seasonal charts that has been collected and analyzed by the Moore Research Center, or MRCI. The Moore Research Center study on seasonality is the A grade cream of the crop, if you ask me. There's a lot of available studies that talks about seasonality, but I believe the Moore Research Center study of it is the absolute best. And I highly recommend for you to just stick to the seasonal charts that's done by the MRCI. And the thing that is of particular interest that I like about the Moore Research Center's study on seasonality is the way that they presented the price charts themselves. It's very clear, right? First, you have the name of the asset class, along with a period of research that covers, which in this case, a 25-year seasonal tendency for the S&P 500 E-mini, ES, from 1997 to 2021. It's a long period of time. And on top of that, it's also broken down into the contract months. Okay. And you can see here we have, much like the present time of recording in January, we're on a March contract. And then we can even see the contract rollover here at about 14 or 15 of March, where we can see a rollover from the March contract into June contract. And then June goes into September, December, and then back to March, because equity indices trades only 4 months of the year. And going back towards the idea of a period of research that this particular chart covers, we can see that it's broken down into different time periods, right? So over here, we can see that over a 25-year time period, the black bar chart shows us that we can see a low being made at the end of January. So generally speaking, again, at the time of recording, we would expect, based on this seasonal chart, we would expect bearish price delivery towards the final weeks of the month of January. Okay. And when we look at a smaller period relative to the 25-year period of research covered here, represented in these dotted lines, we can also see that price also respects that seasonal tendency for bearish price delivery in the final weeks of January. And when we look at the divergences, say when we go down to a shorter period of a 5-year pattern, we can see that there's a much larger price ranges being made. For example, over here, there's a high that's being made in January, but there's also a small sell-off towards the end of January. So although it's not as pronounced as the sell-offs that we can see at the end of final weeks of January, within the 25-year period and 15-year period, there certainly seems to be a tendency for bearish price delivery during the final weeks of January. Okay, and it's a very, very interesting once you look at price like this, and because it gives us a wealth of information that's presented to us in a very clear and usable way for us as traders to anticipate how future price will unfold. Now, when we look at the horizontal columns, we can see that each month is represented by per column from January to December. And when we look at the later half of the year for the S&P seasonal charts, we can see a wealth of information, further wealth of information that's presented to us, where we can see that there's a sell-off, there's a high that's made in April and then the beginning of May before we see extended sell-off or bearish price delivery going into May. And these are what I call the summer months, as I've maybe have mentioned in passing last year. And as you know, last year, if you remember during summer, it was anything but peaceful. It was anything but quiet, so to speak, right? We saw a bullish price delivery instead. But historically speaking, if we were to look at the seasonal tendencies between May to July, price for U.S. indices, the S&P ES, they tend to consolidate during those months. Okay, and you can see this from again June all the way to September as one large consolidation before the final quarter of Q4, we can see a rally higher. That's what is known as the Santa Claus rally. Okay, you can see here December, that's a December contract, right? You can see that's the Santa Claus rally that they're mentioning, that you always hear and utilized in by traders. You can see that there's a low that's being made, again, looking at the 25-year, in mid-December before bullish price delivery into the end of the year. And if we look at the previous 5 years seasonality, we can see that that low occurs not at the middle, but towards the start of the final quarter of December, and we can see it pushing higher in terms of bullish price delivery. Now, when we think about seasonality, um, fundamentally speaking, uh, these markets, we already know they're not random, right? They are engineered by the market makers, but they're also cyclical. And this is most prominent if you trade commodities or commodity futures. Um, what else um is cyclical is equities as well. Are also considered a cyclical asset, much like commodities. Now, the reason for this is that large institutional participants, they operate on predictable cycles, meaning to say that they're on a schedule. They follow a calendar. Now, these cycles, they could be fiscal cycles, monetary cycles, reporting cycles, right? If you ever worked in oil and gas, you know that the oil and gas industry is very cyclical in terms of their capex delivery, their financing, and so forth. All of these cyclical nature of these institutional participants, what it really means is that it leaves statistical footprints in price, which we can observe. That's what we can see in terms of seasonal tendencies. Now, seasonal tendencies can be observed in almost all asset classes, but they're most prominent in commodities. And if you think about how commodities work, let's say if we were looking at LNG, liquid natural gas, we know that liquid natural gas is more expensive in the winter. Okay. Um, During the winter months, Western countries, so countries in the northern hemisphere, even in Japan, famous LNG buyer. If you were to trade actual real commodities, not futures, not a derivative, but the underlying asset, and you were to trade spot prices of these commodities, you'd know that between September to December, there would be a mad scramble to purchase for these superpowers, really. Countries like Japan, which is the largest LNG buyer, at least for Malaysian LNG. There's a mad scramble for these institutional participants that pushes up the price of the commodity. Now what about another form of commodity, something like coffee? Well, coffee, we know when coffee has to be harvested. In Brazil, for example, when coffee will be harvested in Ethiopia, and when coffee will be harvested in Sri Lanka. This is what is called by harvest cycles. And they're very predictable. It's repeated, which helps us as traders because we can use these repeatable, predictable cycles as a way to anticipate future price moves. But what about other asset classes, financial markets, the ones that we trade in, equity indices? Yes, they too exhibit similar patterns driven by calendrical events. If you started out trading equities, you may or may not know that there are dividend payment cycles, right? Year end balancing, which usually comes after market close. So if you're not careful, it often appears in the same way that volatility injection appears in the economic calendar during a high impact news driver, something like CPI, NFP, and so forth. So it's, but the thing about these calendrical events is that it has to be scheduled, right? Some are a bit tricky. Some are only reported after or during the actual event. But the point that I'm trying to make is that it's consistent. And we can anticipate these events happening year in and year out, quarter in and quarter out. So understanding all of these factors helps us to, first of all, reduce the perceived randomness of price and of markets. It also helps us frame directional bias. And it also helps us align with institutional order flow, whether it's bullish or bearish institutional order flow. Now, there's two ways of looking and utilizing seasonality. The first is what we call as a predictive signal. And this is more often than not used by retail traders. And they tend to utilize seasonality as a way to predict specific price paths. To them, seasonality is like a map. It shows these retail traders where to go and what to do, how to get from point A to point B. So they use these seasonality or seasonal tendencies as a way to enter and exit their trades. The thing about utilizing seasonality in this sense is that it creates a false sense of certainty, as if it was a given and guaranteed that a certain asset would deliver on schedule in the way that it has historically, when we know, just based on last year, that that certainly wasn't the case. Go back and look at market structure of the ES on a higher time frame and tell me, what do you see? It's one-sided, isn't it? Well, if precisely. So if these retail traders were to use seasonality as a predictive signal, utilizing it like a map, and utilizing it as a set process or rule within your trading, they would find that they would be in a losing position because there's no additional analysis, number one, that informs or confirms the validation of their anticipation of a price move. They're just following what they believe a seasonal tendency to be. And to top it all off, it's very common for retail traders to utilize seasonality within day trading. So they utilize it as a way to frame their bias on lower time frames intraday, and in order for them to scalp. So that is the wrong way to use seasonality. The way that we want to be using seasonality or seasonal tendencies is the same way a professional utilizes seasonality. And it's utilized instead of a map, it's utilized as a compass, an almanac. The difference here is that where a map predicts with some level with high level of certainty that this is how you're supposed to get from point A to point B, this is the path, just follow that path. A compass, again, gives you a probability whether that fact, that given fact, is likely true or not. So that's a key difference between the two. A professional utilizes seasonal tendencies as a way to provide a general directional context. Additionally, a professional minded trader utilizes seasonal tendencies as a way to filter out between a bad trade idea and a good one. On top of that, instead of dealing in absolutes, a professional minded trader utilizes seasonal tendencies to balance the probabilities of the likelihood of a certain markets to unfold or behave or deliver in a certain way. And finally, instead of utilizing it in day trading, utilizing it to scalp, um, the professional utilizes seasonal tendencies as a tool to confirm and validate what they can already see on a higher time frame in terms of market structure and institutional order flow, pools of liquidity that remains untapped and have been tapped, and inefficiencies. So having seasonal tendency on top of that gives the trade idea a lot more weight. But they always begin by looking at the higher time frame. So let's look at the difference between a bullish and bearish seasonal tendencies. So during bullish seasonal windows, where we see a tendency for price to be bullish, what we will see is markets, they tend to reward patience for those who have gone long. Okay? And what I mean by that is that during a period where we're expecting bullish price delivery, if we were to go long, knowing for the fact that seasonality is on our side, um, if we were to hold that trade, those are the periods in time where swing trading, for example, in holding for a large range expansion to the upside, the probability of those sort of trades happening is much, much higher within a bullish seasonal tendency period. All of the price delivery that gives us um, upside or upside expansions, um, they tend to be very fluid. They tend to be very fast and energetic, very efficient. Think low resistance liquidity run to the upside. Very easy, very fluid, very simple. And one of the biggest mistakes here that you could make during a bullish seasonal tendency is trying to fight it. Okay. Um, and the technical term when you're trying to fight a bullish, a period of seasonal uh, period where we're expected bullish price delivery, the technical term for that is you're trying to fight strength. And what you're trying to, which is to say that you're trying to short a particular market when historically that market has time and time again statistically proven to deliver bullish price. And when we look at bearish seasonal tendencies, uh, the flip side is observed. Here, markets, they tend to punish complacency. All of the downside price delivery that we see, they too become faster, sharper, and quite aggressive, less forgiving. And the biggest mistake that you could make here is trying to pick a bottom. And if you're on the wrong side of the trade, you're offside. Um, you're convincing yourself that price simply has to reverse. So the thing about seasonal bias, it doesn't tell you what to trade. It changes what you are allowed to look for. And again, it acts as a filter in order for you to utilize it in trying to find a directional bias. It is not, again, not the end all be all, much like what retail traders tend to look at seasonal seasonality and seasonal tendencies of price as an absolute truth. Okay? Which brings us to our next point, which is really non negotiable. Seasonal tendency is worthless without confirmation from current market structure. If the two conflict, price always wins. If there's a conflict between a seasonal tendency against what is clearly, obviously, what we observe in market structure and institutional order flow, not supporting that particular expectation of, say, during a bullish period, it's very clearly that we're expecting, and we can see that in the market structure and institutional high time frame institutional order flow, that it's very likely to actually do the opposite and deliver bearish price delivery. Okay, so there's a conflict in this example. In that sort of situation, who would win? Seasonal tendency or price and market structure? Well, price, in those situations, price will always win. Okay. Now, what we see here is what I call the alchemist formula. We need to blend our understanding of seasonal bias, seasonal directional bias, Let's say that we're expecting bullish prices because historically, during that certain time period for that particular asset, we've seen with repeatable bullish price delivery, what we need to do is blend that with what we actually see in terms of actual high time frame market structure. We need to look for confirmations in terms of price. Um, that could be any one of those concepts which I've already taught you, blended together. Concepts like high time frame points of interest and efficiencies, and a reverse in order flow from bearish to bullish, for example, and we can see a break of structure. Okay, if we were to observe that on a high time frame chart, coupled with our expectations where we're expecting bullish seasonal tendencies to be on our side, and here's the third box, we can see very clearly that price is very likely, probably going to deliver into a clear draw on liquidity. Okay, which in this case would be buy stops resting above all highs. If you were to combine all of these things together, that's how you can establish a high probability narrative. Very clear, right? So, everything that I've taught you so far up to this point, in terms of establishing a high time frame perspective, seasonality, you can start that process with seasonality. That's how you'll be able to incorporate that within your trade process on a very basic level. But having said that, we don't want to trade just because of the season. We use the season to add conviction to a trade that is already valid based on price action. So, what do I mean by that? If what we see in terms of high time frame market structure, we've received confirmation in the form of, say, a breaker structure to the upside, and we can see price being supported by a high time frame institutional swing point, for example, that is in confluence with uh, inefficiency, a liquidity gap on the 4-hour chart, for example. And we can see that we are in discount. And very clearly, there is a very clear drawn liquidity in the form of buy stops resting above all highs in a premium. Having seasonality on top of all of that, that adds to our idea, trade idea, our conviction, right? That we're convinced that it's another reason for us that adds into the probability that our trade idea is probably valid and likely correct. It's a way of adding added confirmation. Do you understand? Good. Now, let's look at the 5 steps of how we can incorporate this within our execution workflow. Now, step one, we want to identify a seasonal tendency of a particular asset that we want to be trading. Okay. And more likely than not, if I teach you to be a specialist within a particular asset, you would want to be studying what the seasonal tendency for that particular asset is. Is it historically bullish, bearish, or neutral at that point in time? Or you could plan ahead. Now, step two, we want to define what the directional bias is. And we always begin with a high time frame narrative. So, for example, if we are in a bullish dollar index or Dixie window, what does that mean? Well, it means on a very basic level, right? If we're expecting bullish seasonal tendencies for the dollar index, that means long USD. Is that correct? Sure, on a basic level. But look back at your notes as well as the slides when we talk about intermarket analysis and when I mention risk on, risk off scenarios. And if we see the dollar index rallying, that means all the other assets like equities, commodities, and so forth, they would be selling off. Okay. So I'm just throwing it in there. There's a way to incorporate each understanding of all of these concepts that I teach you. Now, what about if you were to compare this bias, right, with and align it with a high time frame market structure, right? Does the price action that you see within the high time frame support the narrative or confirms the narrative that it is indeed going in the direction or price delivering in the way that you expect it to? And step four, you want to wait for price to reach a valid point of interest and look for other forms of confirmation, such as breaker structure. And step five, you want to execute using your existing trading model. Now, notice how seasonality never tells you when to enter. Did you get that? Let's look at the seasonality based on the ES or S&P 500 E-mini on the 25-year seasonal basis from 1997 all the way to 2021.